Spring-loaded options are stock-based compensation granted to a company's executives right before the company announces good news. For example, in July of 2020, Eastman Kodak granted options to its CEO right before the company announced that it was being approved for a loan. The stock price jumped and the value of the options increased dramatically. This caused a lot of people to criticize spring-loaded options. But let's just talk about the accounting. When a company issues stock options to its executives, it needs to record compensation expense for the fair value of the stock options as of the grant date. Thus, if a company grants options to its CEO on January 20th, and the fair value of those options is $10 million as of January 20th, the company needs to record $10 million of compensation expense. But what if the company knew that on the very next day, January 21st, it was going to report better than expected earnings? Or that it was going to report that it had landed a contract with a major customer? This would be good news, so the stock price would probably go up the next day. And if it does, the value of the options would go up. So let's say that the company reports good news the next day and the value of the options goes up to $13 million. The company essentially granted options with a fair value of $13 million, but it recorded compensation expense of just $10 million. Thus, compensation expense has been understated. And this is where the Securities and Exchange Commission got involved. On November 29, 2021, the SEC issued Staff Accounting Bulletin number 120. This says that companies granting options before disclosing material non-public information need to consider whether the stock price on the grant date needs to be adjusted when valuing the options. That's a lot to take in, so let me make this simple. If a company is about to grant options to its executives right before it discloses good news that is probably going to increase the stock price, the company should consider adjusting the stock price to reflect this information when it records its compensation expense. Because if the company doesn't account for the higher stock price and volatility when it values the option on the grant date, compensation expense will be understated. Now, to be fair, companies frequently possess material non-public information. Thus, SAB 120 focuses on non-routine awards that are intentionally granted prior to announcing good news with the expectation that the stock price will go up. An example of non-routine would be a company that normally awards stock-based compensation every single year on January 31st, but suddenly gives a bunch of options to its CEO on January 17th, right before a press release that announces better than expected earnings. Finally, if a company does grant spring-loaded options to its executives, it not only needs to think about adjusting the stock price when it's valuing the options as of the grant date, but it also needs to disclose the characteristics of those spring-loaded options if those characteristics differ from its normal stock-based compensation awards.